we're really trying to measure what are investors reading, whether it's fake or true, and how might they react to that. We have invested through our partnership with MediaStats a lot of time and energy in thinking about bias. And not all bias is malicious. Ultimately, if there's malicious bias creeping in, there are ways of evaluating sources and adjusting.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world.
Will Kinlaw is Senior Managing Director and Head of Research at State Street Markets, the capital markets arm at State Street Bank. He holds a MS in Finance from Boston College, a BA in Economics from Tufts University, and a CFA designation. He joined State Street in 2002. And here is Will. Will, thank you so much for joining me. We've been at least I have been looking forward to this for quite some time, and since we met.
And Philip, thanks so much for having me. It's been great getting to know you and great listening to some of the, after I met you, going back and listening to some of the episodes of the podcast. So I'm delighted to be here.
I know you're the Senior Managing Director and Head of Research at State Street Markets, and also the capital market arm, basically it's of State Street, the bank, which itself, where you're responsible for a global team of about 60 people, data scientists and quantitative researchers and all those math people, I guess, or data science people. And of course, economists, as well as firms partnership with data scientists, startups and academics and so on. And through this process, the team delivers proprietary investment indicators and data-driven trade ideas and award-winning research to all the institutions who, I think 1,000 institutions who are clients. And I'd love to learn more about that sort of today, of all the research and all this stuff is such a terrible technical word. All the help that you give others through your work. So maybe tell us a little bit about the bank and the structure first, because the people who don't know State Street and don't know all the institutional clients, maybe give us a background so that we can get into some of the research.
Sure, absolutely, and you don't have to nudge me too much to talk about data and investment signals and models. It's what I love doing. So I'm looking forward to the conversation.
Great.
Yeah. So State Street, we're a global financial services firm. We are also a globally systemically important financial institution.
Yes.
And that's probably for a number of reasons, but one of them is because our core business is custody and accounting services for institutional investors. So for example, one of the services we offer is we compute daily NAV values for mutual funds. So we're systemically important because that's a critical function, right? To be able to provide that every day.
Right.
We have a whole business around servicing assets. That's our core business. All the custody, performance, fund calculations, NAVs, all sits there. We also, in that business, have what we call alpha, which is our front to back. So we offer everything from the front office to the back office, from order management, middle office to the trade confirmations and custody and accounting that goes on. So that's in the center. And then we also have a large asset management business. We launched the first ETF. SPY is a State Street Global Advisors product, and there's a whole range of ETFs and other asset management products out of that arm. The third arm is where I sit, and that's the markets arm. So we're a global trading and financing business. We are a top player in foreign exchange. We do quite a bit in equities. We also have one of the largest securities lending businesses in the world. So all of the trading and financing functions sit here. And the job of my team is to provide research to those clients who are predominantly asset managers, hedge funds, pension funds, sovereign funds. And we really focus on the front office. So we focus on the investment decision makers. And our job in research is to give them tools and in your words, stuff that help them do a better job and beat their benchmarks.
So I need to be one of those institutions because all I want to do is beat my benchmark.
Well, don't we all? And the great irony is not everyone can, right? In equilibrium, not everyone can.
And this is why it's fascinating about some of the on a very superficial level, I know some of the things that you guys are doing. And it's not so much that you're giving us the answers, because information is only information at the end, no matter how great the information is up to us to interpret that information and then move forward with actions. But at least you have done the hard job of giving us the information. If you can imagine, it's an information-free world where I don't have any information. How am I going to make any decisions, right? So I think what you guys are doing is really adding a lot of value from what I have understood in very specific areas.
Well, I tell you, I think that's such an insightful point. That's not well understood. Is how does anyone in any context make great decisions?
Yes.
And I'm a big fan of presidential history, U.S. presidential history, and a good president and good staff for a president bring multiple perspectives. They want to sit there and watch an argument unfold in front of them, and they want to hear the best points on either side. And that is exactly how our best clients function. They want to hear different points of view,
yes,
different arguments, so that they can decide. And it's funny, every once in a while, one of our senior executives who's doesn't have a background in research will say to me, like, "You have two analysts who disagree. We've got to fix this. We've got to get them, aligned. We've got to get them synchronized." And I say, "Wait a second. Actually, our clients value that. They want to hear the debate. They want to hear both sides. They want to figure out what they're missing." So I think you're dead on, Philip.
So a Socratic way of presenting all the different views, and hopefully the leader or the decision maker or the investment manager, whomever, and they still can be wrong. But in any event, which is why I think make what we do on our side, where we are actually doing asset allocation, portfolio construction, on the one hand, of course, challenging, but on the other hand is never ending of possibilities. I mean, it's one of those things that just give life by being just in our business. They are unpredictable, and it's really challenging your own intellectual capacity to understand and to make decisions and pull that trigger. And it's that much harder because you're pulling the trigger for somebody else's money, which you have the responsibility as a fiduciary. So
no, it's a huge challenge. I mean, it's an intellectually engaging one for sure.
Yes.
But you're right. It is for many in our profession. It's other people's money, and our mission at State Street is to create better outcomes for our clients who are institutional investors and the people they serve.
Yes.
We're always thinking about those end clients, and that's really the goal, is getting the best outcome for them.
We often think about United States being a very special place. I'm talking about geographically, right? We have land, we have two neighbors who are friendly to us, we have two seas that's huge next to us. So geography is really a God's gift to the people of that land. And I use that. You say, where is Philip Chao going with this? It's that your physical location in Boston is a gift because of all the wonderful educational institutions around you. I think the whole world, whoever listening, even in Botswana, they will know there's Harvard very close to you, MIT, and so on. You have provided me a brief description of many of the research partnership that you have. Talk a little bit about that, and then I will ask you some questions.
Yeah, absolutely. And really, this goes back to the mid and late 1990s when the dot-com bubble was inflating, and everyone wanted to launch a website or an internet-related business. And at that time, markets were going wild. And my predecessors here at State Street in the kind of fledgling markets arm were looking for a way to compete as a markets business. We're not in New York.
Yes.
As you just said, people don't look at us and think, "Oh, that's where I would go for institutional grade trading." That's changing. But the thinking was, how can we compete? What natural advantages do we have that these others don't have? And you're exactly right. One of them is geography. And we're right here. Boston has, I don't know about the exact ranking, but if you ranked cities in the world based on academic institutions and concentration of students and professors, we've got to be in the top 3 or 4. And that's a huge advantage, but especially so in this field. If you look at finance and economics, between the universities we have, MIT, Harvard, Boston College has made tremendous strides over the last couple of decades. Boston University, Tufts. I mean, you just have, I'm leaving many out, But you have so many great universities here. And so the thinking was, how can we tap into that expertise? Because I think many in our profession who are practitioners don't recognize how much academia has influenced investing. We would not have index funds if it were not for modern portfolio theory.
Right.
We would not have the whole concept of the Sharpe ratio. I mean, Sharpe himself is literally an academic. He's a Nobel laureate. We would not have the concept of beta. We would not have many of the risk concepts we use. And sure, you can point out weaknesses in all of these, but fundamentally, they're very strong frameworks. They have had seismic implications for our industry, the way people build portfolios, the way people invest, and they started in academia. So we're big believers in the academic world as a great source of new ideas and fresh thinking, and so set out back then to find partners at these universities who were not only steeped in the theory and the latest thinking from the academic world, but were also interested in practical challenges.
Yeah.
And that's really the balance, right? Is finding the professors who don't just want to describe things, but also want to predict things and find better ways of doing things. That was really the goal there, was to find that edge. And I'll add one more point, Philip, which is many of these professors can't be bought.
Yeah.
And what I mean by that is, the old model for engaging academics, and you still see it sometimes, is that a bank or a big asset manager dangles a huge paycheck and says, quit being a professor, come over here and manage assets. We see some weaknesses in that approach. First of all, it means that professor is not as exposed to those great new ideas and graduate students and everything, all their colleagues, and the great conversations that happen in the halls of academia. But it also means that they have new incentives, right? That may lead them in different directions. So our model is to partner. We work with them where they are. They remain professors, and some of them I don't think you could ever get to stop being a professor. They love what they do. This is talent that we can only access this way. So it's a model that's worked very well for us.
Terrific. A little over a week ago, we had an election. I mentioned this because so much of what we're going to talk about is being talked about today. I just had a committee meeting this morning, investment committee meeting, and one of the question was about inflation, which we're going to talk about in a moment. But before we do that, I think a lot of thinking has changed because Trump is getting a second term. I know we are not going to talk about politics, nor are we going to have you be predictive. That's not what the purpose of this. But clients are all interested. Okay, now with the new administration coming in, with appointments being made, assuming they can get through, how do we plan forward? The entire quest of human beings since beginning is to try to find what's happening tomorrow before tomorrow comes up, right? I mean, it's really risk management in some ways. The other is really curiosity and then getting an edge, right? So we can maybe make more money or protect our money better. So I know you work with Professor Daniel Dressner at Fletcher School, and on basically international policies and politics. Tell me a little bit about how he may be helping or offering data or offering thinking to your clients through your third arm currently when you think about that, and just sort of give us some color on how you use that relationship.
Absolutely. So we've been working with Dan for not that long. He signed on, as I recall, at the end of last year, at the beginning of this year.
Yep.
And he's fantastic. I mean, what's great about Dan is that he is, first of all, steeped in U.S. politics and foreign affairs, but he also was an economist. So he worked at the Treasury Department early in his career, and he really understands economics and markets. And that's really what we're trying to bring to our clients. We're not here to with any sort of political agenda.
Right.
But what we are here to do is help them understand how politics and foreign affairs have the potential to impact their investments and markets. And that's where Dan really complements what we have. Mm-hmm. We have a range of capabilities. I think we're probably going to talk about, for example, what we do with our media stats work or geoquant work. And Dan is really providing a really good expert judgment overlay, helping us look at all this data, combining it with everything he's seeing, and helping our clients think through what are the potential outcomes they need to worry about. So, for example, as you I think alluded to a moment ago, one of the things many of our clients are worried about, particularly more so with the Trump presidency, is inflation. Obviously, there are a lot of things that the market liked about a Trump presidency. So you've seen the Trump trade evolve over the past week or so. Inflation is a concern because so many of the policies, whether it be immigration or tariffs and so on, could, in theory, lead to higher inflation. So one of the areas we're really focused on is helping our clients detect what's going on with inflation and get an early warning signal for the impacts that this may have on the economy, so they can get ahead of that.
So in this case, it's not using data. In this case, it's really using his area of expertise in looking at the trend and potential trend based on what has already been stated by the incoming president and his policies. Is that how you would use that relationship?
Yes, with Dan specifically, absolutely. And in general, when we think about investing, judgment and quantitative and data analysis need to complement each other, right?
Of course.
You should never rely exclusively on one or the other.
Correct.
You should always rely on both as complements. And we have some really good data, which I hope we'll get to talk about when it comes to media sentiment, it comes to inflation, it comes to geopolitical risk.
Yeah.
And what Dan brings is an overlay of just fantastic experience and judgment, because as we all know, in politics, in international relations, right, there's so many wild cards. And if the polls have taught us anything, the last few election cycles, it's that the data can be wrong. So that sort of expert judgment is really helpful.
So let's just take 1 second on that, and then I would like to move on to the price stat, which is really, really interesting stuff. I was thinking about polls, and I was thinking about polls is really about data and collecting data, and it's about how you ask and who you ask, all those type of things. I know you're not in the polling business, you're not in the politics business, but you are in the data business. You're in the data collection business. Do you learn anything from what has transpired to be such a close election? On many levels, it's still very accurate. It's still very close election. There's no question it's still close. But the outcome is so dramatically one-sided. And not only the presidency, but also the Senate at the end, and now the House. Do you have, as a firm, in saying, we're not trying to tell you the politics, but we will tell you that here are some of the issues that we have observed through this experience, that the polling data is seldom correct for the following reasons? Or do you have any thoughts on that as a firm?
We don't really do anything specifically oriented toward polling.
Okay.
We do have some of our own measurements of themes related to the election and to policy from the candidates, and how those themes correlate to investment. So we can help our clients figure out, look, if you're concerned about a particular outcome or predicting a particular outcome, how do you set up your bets to basically align with that? And that's actually quite tricky. And polls are not a good guide for that.
No, it's not.
They're not. You can't look at the correlation between polling data and assets and come up with anything useful. But you can, and I think we'll get into this, you can build signals from social media and general media coverage, digital media, that relate to themes like trade wars and trade policy.
Yes.
And you can correlate those to assets, and you can get some really meaningful results that help investors figure out what are the thematic risks I'm exposed to, and if I want to express a view on a theme, how do I build a portfolio to do that? Those are the kinds of things we can answer with the data.
So shall we say that what you're trying to do is not offer opinion? What you're trying to do is to say, if you have an opinion, here's the statistics, here's the data, and how we can show, if that is your opinion based on this data, how you may want to respond. But you may or may not agree with that opinion of the client, but that's the client's opinion.
So in this context, that's absolutely right. We do, within our research team, we have a team of macro strategists whose job it is to look at all this data and offer opinions. Because like we said at the beginning, some clients want to hear that debate. They want to hear someone come in and argue with everything they have that the S&P is going to return X next year, or the dollar is going to go down, or whatever it might be, and give all the reasons for that. And our strategy team does that, and I think does that very well. But we have both. Sometimes clients want an opinion, and sometimes they want data and information to help them inform an opinion or express an opinion. And so that's part of our job, is to figure out what in our toolbox are we going to plug in to help them achieve what they're trying to achieve.
Terrific. So let's talk about the toolbox. Price stats. Again, I was mentioning to you, I was at a committee meeting, this investment committee meeting this morning, and one of the question was, I really think that the Fed made an error, or more and more so, especially this election has demonstrated. He did not use this word, we vote with our pockets, right? And that has always been something we understood. And that apparently a lot of Americans walked into the polling booth, put their hands in their pocket, and didn't have enough, whatever they felt, that the price level was too high, which is what we call inflation. Which I purposely use price level because price level is not inflation, it's not the same thing. And the average consumer, including you and me, go to a restaurant and say, well, the prices are high. Well, the inflation is already way down to 2.3%. Well, I don't care, but I can't buy the same basket of groceries with the same $100 in my pocket. So tell us a little bit about how, I think I know how Fed look at data. I know probably Fed use your data as well. Talk to us a little bit how your data would, if was interpreted correctly or have done the right thing, that maybe the Fed would have raised rates sooner than later. I don't know if you understand my question.
I do. Yeah, I see. I think I see what you're saying. I think you're asking, could policymakers improve their response by using kind of more advanced data,
right, real-time data, and I know they do. I mean, they have access to real-time data.
Yeah.
Even though they talk, most of the time they talk about CPI, U3, employment, unemployment, and so on. But I am trying to understand that with all that, they have 300 PhD economists, they have data scientists, they have all these, they have tremendous resources.
Yeah.
What do you think it is that caused them to feel that this is transitory, this is not happening, even though it seems like the real-time data, the price stats, if you would call your stuff, is showing something, pretty much going up this way. It wasn't coming down anytime soon.
Well, a couple of thoughts on that, and it's a great question. I think let me first just tell you what we're trying to do with this data, in case your listeners may not be as familiar. So. This is a partnership with a fintech startup called Price Stats, which you mentioned, that we forged back in 2011. State Street's an exclusive partner with Price Stats, and really proud to be working with them. They're great people and have really done some incredible innovation. What they're doing is building their own inflation gauges using online data. So whereas the federal government, and this is true for most countries, by the way, puts out an inflation number every month. And everyone gets all excited. Right outside my office here is our foreign exchange trading desk. And I like to go out there on the mornings when an inflation number comes out because the whole market's watching it. It's pretty exciting.
Of course.
You have our strategists kind of yelling out whether the number's hot or cold or kind of on target. And then clients are calling to put in orders. And there's a lot of activity. So the idea is with online data, you don't have to wait for the month, right, to come around. I mean, you can measure it every day, and you can look at millions of products that are sold online, build a CPI gauge that's akin to the government CPI. And it's not only that you get it every day, it's also that you get it with a shorter lag, because typically the number, like right now we're in the middle of November, right? So we won't know the inflation for the month of November until mid-December.
That's right.
So not only is it monthly instead of daily, but there's this long lag period where it's announced. Yes. So what that means is that markets are reacting to yesterday's news, kind of, right? I mean, these trends are persistent, but they're reacting to older information. So the idea behind Price Stats is, why can't we just measure that more quickly? Now, look, there's challenges, right? Not everything is sold online. A lot is, by the way. You can get a lot online, but not everything. And there's various other challenges with it. But at the end of the day, it gives you a variable that is a very nice predictor of what the official data is going to say. And I did a paper with some colleagues and with Alberto Cavallo, who's at Harvard, who's one of the founder of Price Stats, founded with another gentleman named Roberto Rigobon and Pilar Iglesias. So we did a paper where we looked at how online data forecasts official data in 20-something countries, and it's quite compelling. And not only that, we looked at how it forecasts market variables. Because here's the thing: the market gets ahead of the data because people look. For example, one really simple thing to do is just look at oil. Energy is a huge component of CPI. That's why people talk about core CPI, where they strip out energy. So you can get a sense of where these numbers are going to come in by looking at a few things just back of the envelope. What we find, though, is that this data does a better job at getting ahead of what the official data is going to be and of getting ahead of how the market's going to interpret it. And the way you measure that, and I'm not going to go too far down a rabbit hole here, but in financial markets, we call it the break-even spread. So this is the yield spread between inflation-linked bonds, which are TIPS, and nominal bonds, treasury bonds. So the treasury yield will usually be higher than the inflation-linked yield because to hold a treasury bond, you're not hedged against inflation. You demand a higher premium.
That's right.
Right? And the more inflation you expect to happen, the more of a premium you're going to demand.
Yes.
So that spread reacts to how the market thinks inflation is going to move. And we find that online data gets ahead of that. So I want to answer your question because I haven't answered it yet.
It's okay.
I certainly don't want to criticize the Fed or any central bank. That's an incredibly difficult job that they have.
Yeah.
I think, though, and we know that many central banks, because they've said so publicly, do look at this data, including the Fed have talked about it publicly. Their job is harder because of the lags. The real economy reacts to changes in variables like inflation more slowly than markets, because markets are forward-looking. Markets are going to price it in right away. So the bond market, the stock market, they're going to price in these things the moment investor expectations shift. And that makes in advance, even 2 weeks of advance notice, really valuable in markets. I think for central banks, certainly it's valuable to get ahead of it. But for them, if they think about the trade-off between having imperfect data very quickly or much, more complete data a couple weeks later, for them, that trade-off may err more toward we're okay waiting. But we know they look at it. And I'll tell you one other thing. I think where it can come in handy is there was a time toward the end of last year when we were worried that the federal government might have shut down due to budget negotiations. And the Fed president said publicly at that time, the New York Fed president said, look, we won't be flying blind. We'll have other sources to look at because if the government shuts down, the BLS can't publish its inflation numbers, right? So he said, look, in that case, and he named this source as one of the things that they would look at. So I think it's absolutely valuable to central banks. They do look at it. And I think what you're going to see over time is that central banks and statistical offices around the world, and this is already starting, Philip, are going to start looking at things online. And then you're going to see, I don't think in 15 years, I don't think you're going to have inflation numbers coming out every month and being captured in stores the way they are now. And by the way, I don't think you'll see that for retail sales, or I don't think you'll see that for many of these big variables.
So if you think about this, I don't want to focus the entire thing on inflation, but it's such a big thing as we look at the post-election world. It's becoming more of consensus that we're going to have an elevated inflation. It's not going to be a double-digit back in 1970 type shock inflation, because it's not, unless we're talking about 100% tariff on anything and everything from China. That may give us a bit of a shock, but
right.
Barring that kind of extreme, many things from deficit spending and to cutting taxes, so create even more deficit and more borrowing and tariffs and so on. It's all inflationary. So far, if you recall, since the healing of the supply chain till now, it has moved from things are settling down. It is transitory from a goods standpoint. They are not wrong about that being transitory. Just the inflation wasn't transitory because the service sector had just ratcheted up. It's just as goods are coming down. So you didn't feel the transitory aspect of inflation coming down because it was not calculated. But more importantly, is that housing or the owner equivalent rent, that magical term that people are still trying to figure out, is that really what my house will rent for? But in any event, all that is data that's available. I mean, if you want to scrape from city to city, what is the rental price of apartments? You could get that, right? You can get the cost of buying a new residence. You can absolutely get that. Is that something that you guys also do to say, okay, let me tell you, the only equivalent rent is coming down way faster than the Fed has been thinking about, and that we expect inflation to come down more because of those factors? I'm giving just one example. Are those things that you guys are doing as well?
So when you look at our data, the advantage is not going to be as much in the segments like owner equivalent rent.
Okay.
It's going to be more in products that are sold by online retailers.
Okay.
That's where we can really get the data quickly and measure it and impute it into these indices quickly. Now, there are ways of capturing the other components of CPI, but the real timing advantage comes from consumer products.
It's the delta. It's the change of prices.
The changes that happen.
It's the price level change, right?
Exactly, day to day. And that's where we capture that quickly and effectively and across a very broad array of products. And I'll tell you what we're seeing right now. It's a little bit boring. Apologize for that. But really, we're seeing inflation just continually normalizing in the U.S.
Yeah.
So you said it well earlier. We're not saying prices are going down, not at all. But the rate of increase is slowing and has kind of leveled off at a reasonable kind of lower level. And I think this is where it's something we're just going to have to watch, because all these policies, as you said, they have the potential to be inflationary. And you throw in other factors like demographics. You have a baby boomer segment of the population that's retiring. It's a very large segment of the population that's already started. It's already probably almost certainly contributing to tightness in the labor market. My colleague Lee Farage has done some great work on this. So you put all this together, you have a tight labor market. You have potential for more tariffs. You have, as you said, tax cuts, which is a stimulus effectively. You have immigration policy that potentially further restricts the labor force. So, all these things could lead to inflation. And I think our approach is, how can we measure that quickly?
Yeah.
How can we get an early warning?
Yeah.
And we're exploring, we have the inflation data we have is fantastic. But we also have, we're exploring ways that we can tap into the labor market more directly as well to see how things are evolving there. And I can't say too much about that right now, but we're really excited about, really where we can go in terms of measuring the real economy on a daily or even higher frequency basis.
Because I'm also thinking about AI. I mean, of course, no conversation is complete nowadays without throwing those two words in. And how we're still longing for that true, explosion of productivity that we are all thinking about. And productivity is disinflationary. And if you think about aging population on some level, it's also disinflationary. Mm-hmm. So there are counterweights to all the inflationary impulses. And I'm not sure, that's me talking, that the change in goods prices alone is giving us that. So, for example, changes in restaurant prices, meals, pizza, McDonald's, the McDonald index, mm-hmm. changing. There are so many things that you guys have access and potentially scrape the internet for both service data as well as goods data. But goods data is what CPI does. I mean, they go around and say, well, is the butter prices gone up or down? I mean, it literally goes through every single item.
Right.
You could do that as well without the survey. You can just look at what they are doing.
Yeah. So the service side, some services you can measure directly.
Right.
Some services are posted online prices, but other services you can actually proxy pretty well with goods, because in many cases the inputs to services include goods.
Yes.
So think about education. I mean, textbooks are example, right? They go on, right? An input to that. So goods prices are certainly relevant. And what I would say is we're not necessarily trying to measure perfectly what will be the change in CPI or PCE down to the third decimal place.
Right.
What we are trying to capture is the big inflection points. And you asked me this earlier, and I realized I didn't answer it, but you said, these big events in the past where inflation started to pick up, after the pandemic. And that's where you see, whoa. We have these charts. It has the official CPI, which is kind of, it's like a step. It's like a stairway because it stays flat for a month, then it goes up or down, then it stays flat for a month. And then you have kind of moving along every day, you have these higher frequency series. And what you see sometimes is the high frequency number just jumps up or drops off. You saw this in the fall of 2008. I remember looking at this chart and it's just falling off a cliff. And retailers are cutting their prices. And you could see, even before I think the world fully had absorbed what was happening in the global financial crisis, you could see consumer prices dropping. You saw the opposite post-pandemic. You saw suddenly this increase start, and it picked up and just started diverging from the official data. And then, of course, what happens is the official CPI data plays catch up. So it's more about catching those inflection points than saying, CPI is going to be 2.389%, next month. Of
course. What it is, those pivots is what we want to catch.
Yes.
It's not the staircase so much. It's where there is a change.
Yes. The direction of travel is shifting.
Exactly.
And we've all got to kind of update our expectations and absolutely that's right.
And I will exit this inflation because we can talk about inflation for a long time. It's really, really, really important to me. I'm a perpetual student about it because I think it's fascinating, but this is where I'm going. Perhaps interest rate will remain higher, even if inflation is not higher, because bond vigilante will show up one day. In other words, the world is expecting the U.S. to pay a little bit higher price for just keep this debt going and going and going. I mean, for the first time, our interest payment is higher.
Yeah.
A discretionary defense spending budget.
Well, I'll tell you, we're watching that one closely as well, and we're watching through a different lens. Which is that as a custodian with, don't quote me on this, it moves around with the market, but something like 45 trillion in U.S. dollars of assets under custody administration. Our clients are constantly asking us, "Hey, you sit on all this data. What can you tell us? What can you tell us?" And of course, what we don't tell them is anything that would reveal any particular client's activity. But what we can do is look in a very anonymized, aggregated way at the big trends. And one of the things we look at is there evidence of bond vigilantism? Do we see, institutional investors are some of the biggest holders of U.S. debt in the world. Think about insurance companies, think about pension plans that are defeasing liabilities, bond funds, right? They all hold these. So the question is, are we going to see a point where they stop becoming the marginal buyer at these treasury auctions? And we see no evidence of that.
Not yet.
Not yet. But that's another thing that we watch and that our clients are very interested in kind of following.
And that was where I was going as well, to sort of, you have some wonderful data on that, on the direction of travel, on asset allocation. Because you're clearing the stuff. I mean, what they're doing without naming them, of course. I think of you almost like JP Morgan Chase credit card. I mean, they know every consumer just about, but 50% or 80% of consumer have a card with them, or some huge number. I don't know the number. And they know exactly how many people are late in payment. They know if they pay the whole thing off or they only pay minimum, and what are they spending it on? Is it on service, on goods, on travel, on entertainment? In that sense, you guys are the credit cards. The wrong term,
that's
but
a good analogy.
Idea,
it's
right?
a good analogy.
Of your institutional investors, some of the biggest and most important institutions in the world, and you have insight to it, and you see the direction of travel for them. That doesn't make it right, but that's where they are going, and they do move markets. So how does a non-institution of that size really use that information? If you can talk a little bit about how that your other clients can say, hey, I really want to know what's going on. And so does it mean, if they are selling stocks, it's time for us to sell stock too? It's like follow them type of idea? Or what are they using it for?
The way I think of it is it's a way to measure the headwinds and tailwinds in financial markets. It's interesting when you think about asset flows.
Mhm.
At a certain level, if you zoom back and think about it in an equilibrium context, there are no flows.
No.
It's not as if money flows, into Japanese equities. Someone is selling those Japanese equities and someone is buying those Japanese equities, and they're doing it at a price that implicitly they both agree on, right?
Yes.
So when we think about flows, what we're really trying to measure is how a particular large group of investors with a similar type, how they are positioning themselves and behaving.
Mhm.
And what's really interesting about large institutional investors as a group is that there tends to be a large amount of persistence in their flows. So here's what I mean by that. They're all looking at similar information and they're making investment decisions. And so, for example, right now, everyone's saying, okay, our expectations for inflation, probably in many cases just went up, or at least the probability that we might see a resurgence in inflation just went up. I suspect many investment committees are having that conversation. Now, some of them are going to start implementing new trades immediately. Some maybe have an investment committee that they have to go through to get approval. Some maybe are so large that they can't do everything in size at once. They have to spread it out. And so when you look at them as a group, what you see is a trend will start. And that trend has the potential, because they're so large and they can move markets, has the potential to push prices. So this is a way to help our clients understand at a very aggregated level. We don't do anything at the level of a stock, right? It's all about, countries, currencies, sectors. How is this pool of assets moving and how are they positioned? So it really depends how it would be used. But yes, in many cases, it would be, all right, we're thinking of making a move into this particular trade. We'd like to move into this country. If we start to see a pronounced flow in that direction, we might want to move a little bit faster, right? And get ahead of that before the idea catches on everywhere else. So that's really the way I think about it. It's an advantage to our clients to have access to this pooled set of information to help inform their decisions.
And that's definitely true on FX standpoint.
Absolutely. I mean, FX, the flows, can really matter and can be a factor that impacts currencies alongside all the others, right? There's also interest rates and inflation and valuation and momentum, but flows are absolutely a factor that can matter.
And let's marry that thought to, you also have service sort of thinking about optimizing techniques and asset allocation methodologies, where you use tools to measure and manage. We call it tail. I mean, to us, tail risk is so immediately understandable. People say, "What is tail risk?" We're basically talking about normally distributed return position. Middle is the middle, and then you have, as you get more extreme, it looks like tails, right? So we are really concerned about the tail on the left-hand side, where you have abnormal losses, large losses, all the way to what we call black swan events.
Mm-hmm.
So how does your institutional flow, shall we say, right, inform you in that segment of allocation and all that? Can you sort of link that in there, or does it have anything to do with your institutional flow?
I don't think most of our clients are using the flow analytics we provide as a way to manage tail risk.
Okay.
We do talk a lot to clients and with clients about tail risk.
Yep.
I think the flow information is really more. It's like the headwinds or tailwinds. It's like the temperature, the climate.
Right.
These kind of backdrop forces that are going to be an influence on what we're doing. And just to give you an example, one of the tools that we offer that's quite popular, we call it our behavioral risk scorecard. But it basically gives a score between, I forget exactly the numbers, but I think it's like -20 to +20.
Okay.
And it never gets to those extremes, which is why I can't remember where it starts and stops. It's usually somewhere in the middle range.
You run for the hills by the time when it's 10.
Exactly. But, well, when it's 10, so that actually means that investors are very much risk on.
Yeah. You go the
other way.
The other
But
way.
your intuition is right. Absolutely. But the idea is we look across all different dimensions of risk taking. So, risk taking can mean moving out of bonds and into stocks. It could mean within stocks, rotating to higher beta stocks from lower beta stocks. It could mean moving out the yield curve. It can mean moving from government bonds to investment grade corporate bonds, or from investment grade corporate bonds to high yield bonds. You get the picture.
Yeah.
All these different dimensions of risk taking. And looking at each of those, we just kind of score up across them where are investors more risk seeking or more risk averse. So it gives our clients a very high level view of how real money investment capital, institutional capital is positioning and how it's moving. And they're always interested to understand that, because it can have an impact.
And that is more, does it affect trading, or is it really shorter term? Because they flow back and forth. It's not permanent, flow one direction and never turn back. Right?
No, absolutely. I think the horizon is going to be on the order of a few weeks to a few months, typically. It's definitely not a daily kind of measure.
Yeah.
And we put in a lot of smoothing to protect client confidentiality. But it's really more of a measure, and it's all post-trade, right?
Right.
But it's more of a medium-term kind of.
It's already happened, and we say, well, it could happen more.
Exactly.
It could be sort of the beginning of a direction that you may be cautious. You should be cautious.
Exactly.
Or you should get excited about, whichever way, because we want to be on the leading edge of change. We don't want to at the very last part of the change.
No, that's precisely it. That's precisely it.
Right. You talked about other data. You talked about investor behavior. Is that part of investor behavior, or is that there's something else?
Yeah, we think of investor behavior as the work that we do around flows. We also do some work around media sentiment, which I'm really excited about.
Tell us.
Yeah, so we've been working with these professors. One of them, Ronnie Sadka, who's at Boston College. He runs the finance department there. He's actually not only runs it, he's completely transformed and elevated that finance department. It's been moving up in the rankings, and it's really impressive what they pulled off there. And Gideon Ozique, who teaches at EdHec Business School. And what Ronnie, who's Gideon runs the company, and Ronnie's the kind of academic backing. What Ronnie's career is focused on is liquidity in markets, and how investor sentiment and media sentiment drive markets. And I think this is just so important and not well understood.
Yeah.
You may have seen or read the book that Robert Shiller put out, Narrative Economics, a few years ago.
Yes.
Really great read. I read it twice. It basically spells out how narratives have economic narratives, stories we tell, or understandings we have move markets and change economic behavior. And he lays out the entire theoretical groundwork for this. And we're just delighted when that came out, because this is what we'd been measuring and trying to do with this partnership. But what we're doing is we're looking at digital media, so everything from press releases to local news to blogs to major financial news outlets and other news outlets, and using large language models, so the same technology behind ChatGPT and other chatbots, to read all of that news to the tune of, we're talking about several 100,000 sources that are getting scanned every day, and looking for patterns that emerge. And let me give you an example of a pattern. One thing we've been measuring recently is the Donald Trump theme, right? So you can measure how much coverage is there.
Yes.
How does it relate to some economic or market context? And you can measure the sentiment. Is it talking about it in a positive way or a negative way, which has to do with the words that are used. And it's amazing. We actually have over 100 themes that we track. Not all of them are political. We track recession risk. We track the labor market. We track inflation. And what we can create is a map. We call it a map, which basically shows you on one dimension, it's a grid. So in one dimension, how much coverage is this theme getting? And what we do is you have to pick negative or positive. So we pick negative. So how much, we call it negative intensity, but it's how much negative coverage is this theme getting? And that's one dimension. The other dimension is how correlated is this theme to assets? So we typically look at either the US dollar or the S&P 500. And I tell you, it's fascinating. These themes emerge, and for a period of time, markets will be quite correlated with the fluctuations and how they're being covered. And at a certain level, I guess it shouldn't be that surprising. We all read the news. I have like 4 different news apps on my iPad, and I'm always reading them. And investors are reading these things, individual investors, institutional investors, and they're reacting to it, right? So what we find is that these changes in sentiment around these themes can correlate to markets, and they help us understand which themes investors are actually paying attention to and trading on, and which ones may be getting a lot of coverage, but no one's really acting on it.
I don't know which behavioral scientist talked about it. I'm sure one of the Nobel laureates of the past decade. They said that you look forward, you can never figure it out. But when it happened and you look back, it was so obvious.
Yes.
So using what you just talked about, Bitcoin is over 90,000 on many levels. That if you look back and say, well, of course it's going to go up because Trump is pro digital, or at least he turned pro digital in the last 6 months, and that trend, all the stories around it, would that be the type of thing that you could have predicted? Not predicted is the wrong word. You would have identified that kind of trend, just waiting for that one moment where he became the next president or he won. That's what's the trigger that caused it to just fly off the handle, so to speak.
Well, what we can measure is where I think we could have been helpful is not necessarily in forecasting the outcome of that election, but in telling you that the price of Bitcoin had become highly correlated to fluctuations in the perception that he was going to win.
Interesting.
So helping define what is the Trump trade is an example.
Fascinating.
And that's a challenge, as I mentioned earlier, that there were articles in the mainstream press that the polls didn't really help you with that. If you look at how the polls were fluctuating and try to look at assets, you couldn't get there. But with media, this sort of data, you really can. And it's I think really important because themes, you can't invest in a theme.
Right.
But in order to capture the theme or manage the risk associated with the theme, you have to understand how your investments are going to respond to that theme. And I think that's where this data can be really helpful. And Ronnie Sadka has done some really great work looking at momentum in themes. So, that if a group of stocks, a basket of stocks is positively correlated to a theme, and that theme starts to take off, there's a momentum there that continues for a little while. So I think this is an area, I think you're going to see a lot more research in this area in the coming years. And it's an area where we're trying to get ahead and give our clients an edge. I'll tell you one more thing. You'll appreciate it. I know you're a student of central banks. So we can actually we can measure coverage of individual members of the FOMC, right? The policy making body of the Fed, and similarly in other ECB and analogous bodies. And it's just fascinating. I mean, one of the things we find is that the hawkish, dovish sentiment indicator for Jerome Powell tends to lead, for most other members of the FOMC, leads their hawkish, dovish indicator. So you can clearly see statistically in terms of how their speeches and their remarks are covered from a hawkish, dovish perspective, quantitatively, you can see how his influence propagates through that group.
Consistently, yeah.
And so what that means for investors is if you want to get ahead, you might want to dial up the weight of the J. Powell as opposed to overall Fed coverage.
Yes.
But it gives you a sense of the types of things you can do with this information.
They always said there are 3 voices within the Fed that you should listen to. Of course, the chair, the vice chair, and the New York Fed.
Well, certainly our data bears out the chair point, and I'd have to look at the New York.
That's my understanding. New York Fed plays a very important role.
Yeah.
And this is, I think, it's even more interesting now that they have abandoned forward guidance. So they say, right? They say it's all data dependent. Well, if that's the case, then the Fed, the New York Fed, plays an important role as well, right? So if you think about all that, and then we think about what you guys are doing in terms of really seeing data. As I'm listening to you, even though I'm asking you a question, I'm certainly listening to say there is so much there that I need to sit back, think about our conversation, and how do I link all these things together in a cohesive way to me? I'm sure it's cohesive to everybody a little differently. how it cohesive to me, and what are the drivers that helps me to give me internal indication of the potential positive or negative affirmation to my position.
I think that's well put. I mean, this is the challenge that our clients face, and
Yeah.
we have a phenomenal strategy team. I think you've had some of my colleagues on, but their job is to wake up every morning, look at all of this information, look at what's on Bloomberg, talk to clients, and figure out what's important, what's noise, and how it should all fit together. And
that is not easy.
And it requires experience, it requires judgment, it requires outside the box thinking. Measuring, I'm going to stick to measuring stuff. It's much easier.
It is easier, but being in your position is very difficult to fend off every question about where we're going with that information. I mean, I know you do a very good job at that, because you say, look, I'm steadfast. I'm not telling you where it's going. I can only tell you what we got. And then it's up to you to find that relevance within your own framework.
That's right. That's what we're trying to do, is just give that edge. And in that data dependent, you just pointed out, the Fed is basically saying it depends on the data. I think that just makes it even more important.
Exactly.
That we have better measurements, because you can't, you talked earlier about predicting a number of times, about predicting the future. That's ultimately what we're all trying to do in this business.
Exactly.
But before you can predict the future, you have to have a really good estimate of what's happening right now. And there are many parts of our industry, economics, finance, where we don't have that. We don't, I could go to any major endowment fund or pension fund, and I could say, what are your private equity holdings worth right now? They would not be able to tell me. They might give me an answer, but they don't really know. And it's not their fault, but that's the nature of the beast. The same is true for inflation. The same is true for GDP. The same is true for a lot of these variables. And the better we can get at measuring these things, the closer we can get to making good predictions and doing a better job managing risk and forecasting returns.
With AI, with fake whatever, real fakes and deep fakes and all the other fakes, there are going to be challenges in my mind. I'm just thinking out loud. As the world is embracing more data, the authentication of that data, and not only where the source, but really, how do I know that this is true?
Yeah.
And what is true? So we get into this whole philosophical discussion as well.
Well, I think that it's a fantastic question, and I'll give you two answers. One is, what we're trying to do, if I think about the work we're doing on media sentiment, we're really trying to measure what are investors reading, whether it's fake or true. What are they reading, and how might they react to that? Now, if you look at, I'm a big believer in the wisdom of crowds. In fact, it was a great book, The Wisdom of Crowds. You haven't read it yet? Yeah. Sure. I think we talked about that. Yes. But the looking at, part of the advantage of looking at themes and how they correlate to assets is you can see which types of themes are investors actually trading on. And that should give you some conviction that perhaps this theme has more legitimacy to it. But the other thing I would say here is we have invested through our partnership with MediaStats a lot of time and energy in thinking about bias. Mm-hmm. And not all bias is malicious. Bias creeps in. I mean, we all know, I tend to read politically, I tend to read both the New York Times and the Wall Street Journal, because I think if I kind of average those two things, I end up somewhere in the middle. Now, to many folks, they might say those are, so centrist that it doesn't matter. But the point is, you get this different perspective, and there are persistent biases. You can see it even in the way that the immediate weeks after the election are being covered. So what the algorithms do with the way we build these indicators is they systematically adjust for biases that are observed in the sources. Oh. And those biases can arise in a number of ways. But what you then do is when you adjust for that bias, you're looking for deltas, deviations around the bias. So it's like your benchmark may be higher or lower. You may expect a certain publication is always going to be more positive on European banks than another one. But if that one that's usually positive suddenly kind of turns meh,
yes.
that is a negative signal. Whereas one that's neutral, it may be a totally different dynamic. Yes. So I remember when we started looking at this, I told the team, I said, let's take this. We had a nice back test where we were looking at how these signals performed over time. I said, you know what, go in there and into the model and turn off your bias correction. I want to see what happens if we don't make any adjustment. And they turned it off, and the risk-adjusted performance was cut in half.
Wow.
So there's a lot of value in what this is telling you is you want to look for changes around that biased adjusted, average. So I think that is a way of thinking about, ultimately if there's malicious bias creeping in, and I think fake news is an extreme form, right? But there are ways of evaluating sources and adjusting based on the behavior of those sources.
We're looking at a second degree change.
Yes.
It's really more important.
That's right. And I don't think it's a perfect answer, but it is a way that we can build more conviction when we're dealing with data sets that are subject to bias.
We may have a totally different conversation a year from now or 2 years from now on it, but it's changing, right? We're trying to stay ahead of that change in understanding that potential change and how not to get caught one way or the other and continue to be true. Well, thank you so much. I know, again, I could learn a lot more. Just keep going, but thank you for sharing all this great stuff. At the end, is that alpha is not only just what decision they make, but what data they use to make that decision. Is all related.
Well, I think you're right, and thank you so much for having me. I'm biased in that respect. I think you're right.
It's okay.
Thank you for having me. I really appreciate it. It was a pleasure to be here and talk to you.
I turned off that bias meter, so as long as you continue to be biased, I'm happy. Thank you.
Thank you, Philip.
You can always find more episodes by visiting philipchao.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchao.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.